Economic agents providing capital may have different investment horizons. For this reason, they will have different trading methods. This is the foundation of their strategies. A trading strategy represents the action plan that a trader uses for all his trades on the financial market. It is essential for any investor, either beginner or professional, so that any trading decision is planned and following a rigorous plan. The main distinction is between long-term investment and short position. We will therefore discuss the following strategies: swing trading, day trading, pyramidal trading, counter-trend trading, simple trading with slant, and scalp trading. The major gap is between swing trading and scalping, which are two strategies that are opposed to each other for many reasons. Globally, swing trading is basically simply the act of buying shares or other securities and selling them within a period of more than 1 day. Scalping consists of taking position on the market by staying only a few seconds to a few minutes maximum. You will find a lot of videos on the internet, trainers who will tell you that this is the ideal system to make daily gains, but I am thinking that isn't the case, especially if you are just getting started. I will start by giving you the characteristics as well as the advantages and disadvantages of these trading strategies, and I will give you my opinion right after. The swing trading. The swing trading strategy consists of identifying the trend and then trading within it. Usually, after a correction or consolidation, swing traders choose to take a position, either buying or selling, at an opportunistic time and will exit after making an expected profit. In general, swing traders are known as trend followers. If there is an upward trend, they go long, and if the general trend is downward, they might go short. Swing trades stay open for a few days to a few weeks, sometimes even a month, but usually last only a few days. The key point of this strategy is to identify the best entry and exit point through technical analysis using Fibonacci extension, for example, combined with other models and technical indicators. This strategy works well for those who cannot stay full-time connected to the market and follow events minute by minute. The day trading. Day trading consists of buying and selling financial instruments during a single trading day by closing position at the end of each day or during the same day and starting again the next session. The objective is to profit from small price variation. The big difference with swing trading is that intraday trading is definitely not for part-time traders, as it requires time, concentration, dedication, and a specific mindset. Day trading involves making decisions quickly and executing a large number of operations for a relatively small profit each time. This practice is generally considered to be opposed to the most investment strategies, which seek to take the advantage of long-term price movement. Generally, the time unit selected for trading is 30 minutes or 1 hour. If you feel the wish to adopt this strategy, what follows will also perfectly meet your needs. Personally, my portfolio evolves through day trading and also swing trading, depending on the specific type of asset I choose to trade. Small advice concerning day trading. On the stock market, it is common to close position at the end of each day to avoid the risk of gap. The gap occurs when events and other factors lead to a company's share price opening significantly higher or lower than the previous day closing price. For beginners, day trading in Forex or cryptocurrency is often used to avoid the costs associated with a rollover position and to avoid being exposed to the market movement during the night. The pyramidal strategy. It's a strategy that consists of maximizing your profits by straightening your position, as long as the market supports your position. Gains are protected by a stop loss adjustment as the market progresses. The next step is to open an additional position to each breakout of the last higher or lower. The stop loss is moved to protect all open positions below the last low in an uptrend or above the last high in a downtrend. With the Dow method, a new position is opened at each higher break and the stop loss of all positions is moved below the last lower one. We can see on this graph that a total of 4 positions are taken: entry 1, entry 2, and others. Thus, a total of 4 long positions are taken, with the evolving stop loss represented by SL. After buying at the entry 4, all the stop loss of all 4 positions are executed at the same price because the stop loss are moved as the market moves. The last position is a loss, but the other 3 positions are gains, with each a different gain. You have understood all the advantages of this strategy, but let's also discuss the disadvantages. The main one is pyramiding on losing trade. This situation consists of making downward average to reduce your cost price. This type of strategy is to be avoided in trading without strict guidelines. Emotion will then come into your decision, you will refuse the loss and lose your objectivity. Your position will be based on your starting position, which is a losing position, not on the current market condition. You will cling to the hope of reviewing your cost price as soon as possible. It's a bit ironic, but I know that some people will recognize themselves. But this chart summarizes well the step suffered by a trader who did not anticipate the pyramiding on a losing trade. Note that you can also put yourself in a margin call situation if you use leverage. The second disadvantage, psychological management. Traders do not like to lose or most often seek to protect their gains. However, with the pyramidal methods, the opposite is happening. The trader takes the risk of seeing his gain disappear more quickly in the case of a market downturn. Finally, the third disadvantage is that this strategy is specific to certain opportune situations, and this is reflected in your risk ratio or return ratio. For it to be interesting to use the pyramiding technique, each new position must at least keep the risk ratio provided by the initial position. Indeed, additional position will often be based on different buy or sell signals than your original strategy. If the risk ratio is lower, from a mathematical point of view, there is no point in pyramiding, and it's more interesting to increase the volume of your position from the first entry. Day trading with slant. This is a simple trading strategy that requires no technical indicators. The trading strategy is to draw short-term bullish and bearish slant and then trade with the slant breaks to enter or exit the position. Slants are also called trend lines because they inform us about the current trend and its strength. With the use of slant, stop loss are usually positioned above the last higher or lower stop loss. This slant can be drawn on 2 or 3 points of contact as long as the highest and lowest are well marked. Thus, at least 2 points of support must be found. Considered as support, it is necessary to take the low point of contact to draw the upward slant and consider it as a resistance. It is necessary to use the point of contact to trace the downward slant and not the contrary. This graph is very straightforward and simple, because the objective is not to provide you an analysis of the GBP ILS, but to show you the two slants with the break of one of them. We will go deeper into the analysis afterward. Regarding the interpretation, many traders consider the break of a bearish slant as a buy signal and vice versa for a bullish slant. I don't think that this is the right analysis. The break of the slant only tells you about the low probability that the price will continue its initial movement at the same pace. This suggests a correction or a change in trend. The counter-trend trading. As its name suggests, this trading refers to taking opposite position to the trend of an asset. Most often, it involves catching correction movement, a retracement of the trend movement. More rarely, you can take advantage of a trend reversal and then catch a large part of the movement. Counter-trend trading strategies aim to determine the point of trend reversal. To be clear, this is an example. Traders using this approach take indices with inverted candlestick figures. They also apply oscillators such as MACD or RSI to determine if the market has become overbought or oversold, and if there is a divergence between the price and the oscillator. If these indications are present, traders open position against the previous trend. The scalp trading. The scalping approach focuses on the minor volatilities in the intraday movement of stock price, frequently moving in and out through the session in order to make profits. Positions are held for a relatively short period of time, counted in seconds or even minutes, so profits per trade are low. This is why scalpers make many operations, which can exceed 100 operations per session. This trading method is also popular with HFT companies using robot traders. Robot traders represent at least 60% of the operation carried out in the United States. It should be noted that despite the warning about the risk of stock market disruption, HFT is becoming more and more common. Indeed, these robot traders can sometimes cause irrational flash crash. For example, on May 6, 2010, this technique caused a 9.2% drop in less than 30 minutes on the Dow Jones Index for no apparent reason. On this date, other indices such as the S&P 500 and the Nasdaq Composite were subsequently affected. On the other hand, in my opinion, there are some disadvantages attached to this style of trading, because scalping requires a high rate of reactivity, because between the opening and closing position, it can only take a few seconds or even a few minutes at the most, and I'm not sure that a beginner is prepared to deal with the psychological pressure and such quick decision making. Moreover, beyond being confronted with experts in the field, you will have to beat the robot traders that perform HFT. My statement should be balanced, because if you have a good foundation of understanding how to read graph and shoot at the right time, you can become a real sniper. In the end, it all depends on the experience you have and the time you are willing to put in. Here is the summary of the different characteristics related to the two most opposed trading methods, swing trading and scalping. The position duration does not exceed a few minutes for scalp trading, while it can last from a few sessions to a few weeks for swing trading. Thus, considering that swing trading requires only a few positions, it allows you to be comfortable with your decision by giving you the time to analyze the asset you are going to trade. Scalping requires a strong reactivity and therefore a perfect understanding of certain technical analysis tools in order to follow the pace of a large number of positions. Finally, as you have understood, scalping is dedicated to traders who already have a significant experience, whereas swing trading can be used by everyone, from beginner to experienced trader. Therefore, the analysis tool covered in this trading course will be closer to the swing trading method, and they will also be suitable for day trading.